If you want to buy a home and think a 20% down payment is going to give you the lowest interest rate, think again. I'm Brand the Mortgage Man, and I've helped more than 10,000 home buyers over my 20+ year career in mortgages, and today I'm going to help you. So let me be very clear about what I'm saying. A 20% down payment will not get you the lowest possible interest rate. Now, I'm not talking about someone who has the ability to put down more than 20%, because the threshold to see a lower interest rate would really be about 25% down. However, if you're trying to decide whether it makes sense to put down 5%, 10%, 15%, or 20%, you may want to look at those lower down payment options before you make the final decision, and here's why. At 5% down, you are actually able to get a lower interest rate than you would if you put 20% down. Once again, let me clarify. If you have the ability to put down 25%, this is no longer the case. I'm specifically talking about if you're trying to decide between 20% down or less than 20% down. So here's how this works. Check this out. So what I've written up here on my board is a comparison of a $500,000 purchase price with a 700 credit score, putting down 5% and putting down 20%. Now, you might say to yourself, this doesn't even make sense. Why would someone get a lower interest rate at 5% down than they would at 20% down? And we're talking about the same borrower, right? Same purchase price, same credit score. Well, this is why. Something called LLPA, right? LLPA stands for Loan Level Price Adjuster. So what a loan level price adjuster is a preset adjustment that's made to an interest rate behind the scenes by every single lender. And what I'm talking about today is specifically dealing with conventional mortgages, so mortgages that are backed by Fannie Mae or Freddie Mac. So the agencies, Fannie Mae and Freddie Mac, have these loan level price adjusters based on different levels of risk. The risk could be things like the down payment percentage, credit score, the type of property that you're buying, right? Those are all risk factors. Now, believe it or not, there's actually less risk to a lender when someone's putting down 5, 10, or 15% than at 20%. And the reason for that is something you may think is a bad word, PMI, which is private mortgage insurance. When you put down less than 20%, you have to pay PMI on your mortgage. Well, that PMI protects the lender. As soon as you hit that 20% mark, PMI is no longer required, and the lender loses that protection. And therefore, there's actually a little bit less risk to a lender when you're putting down 5, 10, or 15% than if you're putting down 20%. Like I said before, they consider that threshold to reduce the risk 25%, which is why your rates would actually improve at 25% than they would at 5, 10, 15, or 20%. So here's a true comparison of rates that I pulled today just to show you exactly how this would work. So the loan level price adjusters, right, you can see here, this is 1.125%, which would be 1 1/8 points, right? 1 point is 1% of your loan amount. Versus at 20%, it's 1.375 points, or 1.375%, which is 0.25% more in cost, right? Because these loan level price adjusters become cost to you as a borrower. So it would cost 0.25% more, 1/4% more, for you to put 20% down to obtain the same interest rate as what you'd get at 5% down, right? If that makes sense. So these are real rates. At 5% down for this scenario, 7.5%, these are 30-year fixed rates, 7.5%, 0 points, 7.125%, 1 point. At 20% down, 7.625%, 0 points, 7.25%, 1 point. An eighth higher in interest rate between the two. Over a 30-year term, if you were to have a 7.5 versus 7.625%, you'd be saving about $17,000 in interest. That's over 30 years. It's substantial. But you may be thinking to yourself, well, yeah, but what about the mortgage insurance I'm going to be paying, or the higher mortgage balance I'm going to have if I put down 5% instead of 20%? And that's a valid question. So here's what the plan should be if you're going to utilize this technique, right? The idea is, if you're planning to put 20% down, putting down 5% instead, getting your lower interest rate. Before you decide to do that, though, you need to make sure your lender is going to allow a recast. Recasting means that you can make a lump sum payment toward the balance on your mortgage, and you will immediately see a reduction in your monthly payment. Not all lenders will guarantee this, so it's very, very important that you ask this up front of your lender. Don't just assume you can follow this process if they're not going to allow for a recast, because if they don't allow for the recast, it completely defeats the purpose of what I'm telling you here, right? So that's very, very important. It's an important caveat you want to consider. So if you're going to go this route, you put down the 5%, you get your lower interest rate, you close. Before your first payment is due, you're going to make a lump sum payment of the additional 15% that you would have been putting down to get to your 20% down payment. You're going to ask for a recast at that time. The recast is going to reduce the balance on your mortgage. And just so you know, typically on a 30-year fixed rate, fully amortizing mortgage, making a lump sum toward the principal balance will not change the monthly payment. It will just shorten the amount of time it takes to pay it off. That's why you need the recast specifically. The recast is going to do two things, or three things technically. It's going to reduce the balance on your loan. It's going to get rid of the mortgage insurance, the PMI, that you had to pay because you put less than 20% down. And it's going to reduce your monthly payment because it's going to re-amortize the loan based on the new lower balance. So unlike just paying lump sum toward the balance on the principal of a mortgage, shortening the term, in this case, you will see the reduced payment that you'd be looking for. So the real advantage here was you found a loophole to get a lower interest rate in this scenario by 0.125%, saving you nearly $17,000 over the 30 years, assuming you kept the mortgage that entire time. Point being, make sure you speak to your lender about all options to obtain the lowest possible interest rate and save yourself the most money when you're getting your mortgage. Don't just assume that putting down 20% is going to get you there. And not all lenders are going to understand how this works, believe it or not. I take the time to educate my clients and show them, as I'm showing you, why the rate's different. It's not just me saying it. These are real numbers that came directly off rate sheets, and these are the real loan level price adjusters that apply to all lenders. These aren't our adjustments. These are for all lenders that are offering conventional mortgages backed by Fannie Mae and Freddie Mac, which is just about any bank or any lender. So regardless of what they may be telling you, this is 100% accurate. But once again, make sure your loan is going to be 100% eligible for a recast and get that in writing from your lender. Because some lenders may tell you, yeah, of course you can do that. And then you come to find out that you can't. And if it turns out that you can't, well, you ended up screwing yourself, unfortunately, because now you're stuck with a higher payment with mortgage insurance when you were trying to avoid that in the first place, right? So make sure you listen to everything I'm saying in this. Use it when you're having these conversations with your lender in order to get the best possible terms on your mortgage. And if you're looking for more information like this or just mortgages in general, make sure to subscribe to my channel. I have awesome educational videos about all things mortgage and real estate. And if you have questions about your own scenario, make sure to comment below. I do reply to 100% of the comments left on my videos.